If you're holding XRP right now, you need to hear this clearly and without emotion clouding your judgment. Welcome back, because what's forming around XRP at this exact moment is not normal market behavior, and it's not something you can afford to misunderstand. This is not about short-term price noise. This is about a structural shift that only becomes obvious after it's already locked in. And right now, most people are positioned the wrong way for what's coming next. Here's the uncomfortable truth most investors don't want to face. Markets don't move when the crowd feels confident. They move when confidence is lowest and information is most misunderstood. That's exactly where XRP sits right now. The price has been chopping between roughly $2 and $3 for months, and that sideways movement has drained patience out of even long-term holders. Fatigue is everywhere. People feel like all the good news has already been priced in, and that's precisely why this phase is dangerous for the unprepared, because exhaustion is the emotional state that precedes both capitulation and violent reversals. Let's rewind for a moment. Not that long ago, XRP was sitting below 50 cents. At that time, the narrative was identical to what you're hearing today. Dead project, underperformer, regulatory risk, no momentum. And yet, the people who were watching structure instead of emotion knew that phase wasn't about failure. It was about pressure building. Markets don't reward impatience. They reward positioning before belief returns. Now look at where we are today. XRP has already proven it can reclaim multi-doll territory. And yet the mood feels worse than it did at far lower prices. That tells you everything you need to know about retail psychology. Most people aren't guided by data. They're guided by frustration. And when frustration peaks, that's when people make the worst decisions of the entire cycle. At the same time, something far more important is happening outside of the chart. Regulators are no longer treating crypto like a fringe experiment. Institutions no longer speak in hypotheticals. Banks are no longer exploring, they're executing. This is what people miss when they stare at daily candles. Price moves last, infrastructure moves first, policy moves first, capital structures move first. Price only reacts after the system has already shifted. The reason this matters for XRP specifically is because XRP is not positioned like a meme asset or a speculative tech stock. It sits directly at the intersection of regulation, banking, settlement, and institutional liquidity. That makes it slow during hype phases and explosive during normalization phases. That's the part most people misread. They expect it to behave like Bitcoin during mania. It doesn't. It behaves like infrastructure being quietly wired into a new financial system. And here's where the warning becomes real. We are approaching the point where bearish narratives about XRP collapse under their own weight. Not because of social media hype, not because of influencer optimism, but because the structure supporting those bearish views is being dismantled piece by piece through regulation, custody frameworks, treasury strategies, ETFs, and institutional partnerships that don't care about retail sentiment at all. Right now, the biggest risk is not XRP failing. The biggest risk is people abandoning positions right before the reason they entered finally begins to materialize. That's not a dramatic statement. That's historical fact across every major asset transition. The majority always exits during the hardest middle phase. The minority that stays positioned is what people call lucky later. It was never luck, it was comprehension. So when you hear people saying XRP is stuck, understand that what they really mean is their patience is gone. When you hear people saying the market is boring, understand that boring is exactly what accumulation phases look like before they end. And when you hear people growing increasingly bearish, right as institutional alignment accelerates, understand that you're witnessing the same psychological pattern that repeats in every cycle. Disbelief before repricing. This phase is not about chasing pumps. It's about understanding where pressure is building before it releases. And if you don't know what just happened, what's quietly forming now, and why XRP's setup is fundamentally different from what most investors think, then you're navigating one of the most important transitions in this market completely blind. If you're wondering why XRP hasn't already exploded with all the positive headlines floating around, You're asking the right question, but most people reach the wrong conclusion. They assume the market is broken, manipulated beyond all logic, or that XRP has somehow failed to live up to expectations. What they don't understand is that this is exactly what early institutional positioning looks like. It's like when it's happening quietly instead of through a hype cycle. The loud phase always comes last. The silent phase is where the real accumulation happens. Look at the pattern you've already seen with other assets. Bitcoin didn't rip to new highs when institutions first showed interest. It stalled, it chopped sideways, it frustrated everyone. Only after the infrastructure was locked in, ETFs, custody, compliance, reporting, did price begin to reflect the shift. Ethereum followed a similar path once staking and yield became normalized for institutions. XRP is now entering that same phase, but with an even heavier regulatory and banking overlay, which naturally makes the transition slower and more controlled. Behind the scenes, the narrative has already changed. You're no longer hearing questions about whether XRP will survive regulation. You're hearing conversations about how XRP fits into treasury strategies, settlement frameworks, and custody pipelines. That's not retail language. That's balance sheet language. And balance sheet language moves slowly, methodically, and without concern for daily price fluctuations. One of the biggest signals people underestimate is what's happening on the acquisition side. Ripple isn't just expanding. It's absorbing critical pieces of financial infrastructure, custody, treasury management, and enterprise-grade settlement tech. That matters because whoever controls custody controls the flow of institutional capital. Retail can argue about price all day. Institutions care about who safeguards assets, who manages risk, and who complies with regulators across multiple jurisdictions. Ripple is positioning itself directly in that lane. At the same time, you're starting to see the early formation of structured XRP treasury strategies, not speculation, not trading desks, treasuries. That means XRP is being evaluated the way companies evaluate foreign currency reserves, commodities, or strategic assets, not as a weekend gamble. When firms begin allocating hundreds of millions of dollars to an asset under a treasury framework, they aren't thinking in months. They're thinking in cycles measured in years. This is the part retail usually misses because it isn't spectacular. There's no parabolic candle. There's no trending hashtag. There's no viral clip. It's slow contracts, regulatory meetings, custody approvals, internal risk committees, and asset allocation models being rewritten. By the time those processes finish, price already reflects the decision. Retail only sees the end result and calls it unexpected. Now add in the macro layer that most XRP holders ignore when it doesn't suit their emotions. Interest rates do not stay high forever. Liquidity cycles always turn. When the Federal Reserve shifts from tightening to easing, capital doesn't drift back into risk assets gently. It flows with force. That's not opinion. That's historical behavior across every modern cycle. And when that rotation happens again, capital won't be choosing assets based on memes. It will be choosing based on regulation, custody, and institutional compatibility. XRP sits directly inside that selection filter. This is why the current price compression matters. So much compression is the market forcing uncertainty to its extreme. Bulls get tired, bears get confident. Both sides become emotionally loaded. Institutions stay quiet. They let both groups exhaust themselves. And only after supply has been absorbed quietly and sentiment is weak does the repricing happen. Most people think price leads narrative. It doesn't. Structure leads price. Structure is moving right now through acquisitions, treasuries, regulatory alignment, and macro setup, even if the chart doesn't reflect it yet. And that's why the current phase confuses so many people. They feel like they're seeing two different realities at once. Strong signals everywhere, but muted price action. That disconnect is the giveaway. It's the sign that something is being built that hasn't gone public yet. The risk isn't that XRP fails during this phase. The real risk is that people misinterpret consolidation as stagnation and walk away right before the final layer locks in. Because once the structure is complete, the market doesn't ask for permission to reprick. It simply does what supply and demand force it to do. Now we get into the part almost nobody explains properly. The mechanics, not the hype, not the slogans, not the emotional predictions, the actual forces that push price when sentiment is irrelevant. Because XRP isn't going to move when people feel bullish. It's going to move when available supply collides with structured demand. And that collision doesn't announce itself ahead of time. It shows up suddenly after the groundwork is already finished. Start with the simplest reality. XRP does not have infinite liquidity on exchanges. It never did. What exists in circulation is finite. And what's actually available for open market trading is far smaller than most people assume. A massive portion of XRP is locked in long-term holdings, custody solutions, institutional reserves, and structural wallets that do not trade daily volatility. On top of that, there's the escrow system, which releases XRP on a fixed schedule. That release mechanism doesn't react to market demand in real time. It's predictable. Demand is not. This is where ETFs, treasuries, and institutions completely change the equation. Retail buys and sells emotionally. Institutions accumulate structurally. When an ETF or treasury absorbs XRP, that supply doesn't rotate back into the market during a pullback. It's removed from the liquid pool and parked. Over time, that shrinks the available float silently. Price doesn't respond immediately because the absorption is gradual. But once demand crosses a certain threshold and the float becomes thin enough, price stops behaving smoothly. It starts behaving violently. This is why people who only look at daily candles miss what matters. A supply shock doesn't look dramatic while it's forming. It looks boring. It looks like sideways action. It looks like a market that can't pick a direction. In reality, what's happening is that liquidity is being repositioned from weak hands to strong hands without fanfare. The result only becomes obvious when large orders begin to hit thin order books and price has no choice but to gap. You've already seen this behavior in XRP before. Historically, XRP doesn't trend the way Bitcoin does. It compresses for long periods, then releases in short, aggressive expansions that leave most traders behind. That behavior isn't random. It's the direct result of how its liquidity structure changes over time. When XRP is widely distributed and heavily traded by retail, it moves slowly. When it becomes concentrated and illiquid at the margins, it moves fast. Now combine that with ETF behavior. ETFs don't day trade. They accumulate as capital flows in. When inflows rise, they source XRP from exchanges, over-the-counter desks, and large holders. That creates a one-way pressure. Supply leaves the open market and does not return. Meanwhile, retail still assumes that there's always more on the exchange. That assumption only holds until it doesn't. And the moment it breaks, repricing happens faster than most people can react. This is also why your emotional reaction to current price is dangerous. People see XRP drift between $2 and $3 and assume that's all it's capable of. That's not analysis. That's anchoring bias. Price is simply the last variable to adjust. The real adjustment happens in ownership distribution, custody behavior, and institutional positioning. By the time those are obvious to the public, the opportunity to position painlessly is gone. From a pure market structure perspective, the biggest signal isn't a breakout candle. It's sustained compression with growing institutional alignment. That's the recipe for a nonlinear move, not a smooth rally, a repricing. And repricings feel unfair to anyone who sold emotionally during the quiet phase because they convince themselves they'll buy back cheaper. Cheaper often never comes once the structural shift is complete. There is also a bearish scenario that must be acknowledged honestly. If regulatory momentum stalls, if ETF demand underperforms, if macro liquidity tightens again instead of expanding, XRP can remain range-bound far longer than most people expect. That would grind down patience even further. That's the risk side of this setup. This is not a guaranteed timeline. It's a probability distribution shaped by macro conditions, regulation, and institutional follow-through. But here's the key difference between bullish and bearish outcomes. In the bearish scenario, XRP stays boring. In the bullish scenario, it reprices rapidly and decisively once the supply threshold is crossed. There's no slow middle ground once that structural imbalance hits. That asymmetry is what makes this phase so psychologically difficult. You endure long periods of nothing happening so that something violent can eventually happen. This is why most people don't win these phases. They demand emotional confirmation before positioning. By the time emotion turns positive, the mechanics have already done the heavy lifting, and price is no longer forgiving. The market doesn't reward patience with applause. It rewards it with windows that close without warning. Here's where the long-term picture finally comes into focus, and it's the part most people either misunderstand or refuse to think about, because it forces them to reframe what XRP actually is. Bitcoin is no longer a retail rebellion asset. It's institutionalized. It trades like a macro hedge now. Ethereum is evolving into a programmable financial layer where yield and infrastructure matter more than ideological narratives. XRP, however, is moving into a completely different category altogether, one that doesn't fit neatly into how most people learn to think about crypto in the first place. XRP is not competing to be digital gold. It's not competing to be a decentralized app playground. It's positioning itself as a settlement and liquidity bridge for value at scale. That nuance matters because it changes how adoption unfolds. When Bitcoin rallies, it rallies because people want exposure to a speculative store of value. When Ethereum grows, it grows because developers and institutions want programmable finance and yield. When XRP moves, it moves because money itself needs a faster, cheaper, and more regulated way to move across systems. That difference reshapes everything about the future cycle. Bitcoin can pump in a risk-on environment and stall when liquidity tightens. Ethereum can benefit from innovation waves and on-chain activity. XRP's real breakout condition is system integration. Banks, payment corridors, custody frameworks, treasury systems, and institutional settlement pipelines. That means when XRP truly enters its next major expansion phase, it won't look like a typical crypto rally. It will look like a repricing of infrastructure. This is also why the time horizon for XRP holders feels psychologically brutal. Infrastructure takes longer to build than hype. You don't wire a global financial bridge in months. You do it in years. Regulatory clarity, custody integration, treasury compliance, cross-border standards, all of that requires slow, methodical alignment. Retail hates slow. Institutions depend on it. That tension is exactly why most retail investors struggle with assets like XRP, while institutions quietly grow more confident over time. Now zoom 5 to 10 years out and think in consequences instead of candles. If digital settlement becomes the default instead of the exception, the assets that power that settlement don't get treated like speculative chips anymore. They become strategic reserves. They become tools that companies, banks, and governments need to hold in quantity to operate efficiently. At that point, ownership distribution matters far more than short-term charts. If supply is already tightly held by institutions and early holders, when that transition accelerates, the repricing doesn't happen gradually. It happens as a function of necessity. Compare that to Bitcoin. Bitcoin doesn't need to be held to operate infrastructure. It needs to be held to express macro exposure. That's a massive difference. Exposure demand rises and falls with risk appetite. Utility demand compounds with system adoption. XRP's most powerful growth driver isn't emotion, it's usage. And usage scales with integration, not with sentiment. This is also why the idea that XRP is just another altcoin is fundamentally broken. Most altcoins live and die on attention. XRP lives and dies on whether it becomes embedded in real-world financial rails. If it does, it escapes the typical hype collapse cycle that destroys most retail portfolios. If it doesn't, it stays range-bound and frustrating for far longer than people expect. There isn't much middle ground. It either graduates into infrastructure or it stagnates as a speculative asset forever. That binary future is exactly why emotions around XRP are so extreme on both sides. The uncomfortable implication of all this is simple. If XRP truly becomes what it is being positioned to become, meaningful ownership becomes harder, not easier for everyday people over time. Not because of conspiracy, because infrastructure assets get absorbed by balance sheets, not moon boys. The larger the institutions grow within the ecosystem, the more XRP behaves like strategic inventory rather than something people casually day trade. That's why future positioning looks radically different from past cycles. In early crypto, retail dominated first and institutions followed later. With XRP, institutions are building first, and retail is still debating whether it's worth paying attention. That reversal flips the entire risk-reward profile. It means the largest upside is front-loaded into the quiet phase, not the trending phase. By the time XRP is universally accepted as a core financial bridge, the easy accumulation window is already gone. This is also why comparing XRP's future to Bitcoin's 2013 or 2017 phase is misleading. XRP is not entering a grassroots adoption curve. It's entering an enterprise adoption curve. Those two curves look nothing alike in the early stages. But they often converge violently once scale hits, and that brings you back to the present moment. What feels slow now is exactly what enterprise build-out always feels like before it becomes impossible to ignore. What feels boring now is what infrastructure always feels like before it starts moving real money at scale. Most people won't change their view of XRP until after that transition is already reflected in price. By then, the argument is over. So only the aftermath remains. Here's the part that most people don't like hearing, but it's the part that actually determines who survives these transitions and who becomes exit liquidity. The market does not move on your schedule. It does not reward you for how long you've waited. It does not care how confident you were at the top or how tired you feel at the bottom. It only responds to structure, liquidity, and timing. And right now, the structure is shifting whether your emotions are ready for it or not. There is a very real scenario where XRP continues to grind sideways longer than most people expect. Regulatory timelines stretch. ETF flows take time to scale. Macro liquidity ease and flows instead of flooding in all at once. That scenario is painful because it tests patience without giving confirmation. And that is exactly the environment where most retail investors mentally break. They don't quit because they were wrong. They quit because they're exhausted. That's how markets remove weak positioning without ever needing a crash. But there is also the opposite scenario, and this is the one people are structurally unprepared for. The moment institutional demand, ETF absorption, treasury formation, and macro liquidity expansion line up at the same time, XRP does not drift higher slowly. It reprices. It jumps valuation zones. It moves in a way that feels unfair to anyone who sold out of boredom or fear just months earlier. And that's not because the market is cruel. It's because that's what thin supply does when it runs into real size. The dangerous mistake people make is assuming they'll have time to react when the move starts. That's a fantasy. The largest percentage of XRP's historical gains have always happened in short, compressed windows, weeks, not years. If you're waiting for absolute certainty before you position, you're not being cautious. You're positioning yourself to buy after the highest risk portion of the move has already happened. Another hard truth is this: not everyone who believes in XRP is actually positioned to benefit from it. Belief without discipline doesn't build anything. If you're over-leveraged, emotionally attached, or constantly reacting to short-term noise, you're already at risk, no matter how bullish your outlook is. Strong hands are not defined by how loudly they speak. They're defined by how consistently they stick to a plan, when the market gives them no emotional reward. You also have to come to terms with the fact that institutions and retail are not on the same playing field. Institutions are patient. They have access to cheaper capital. They have political and regulatory access. They don't chase candles. They position during boredom. If you try to compete with that using impulse and hope, you lose by default. The only edge retail ever has is time. The ability to accumulate before a narrative becomes obvious. Once the narrative is obvious, the advantage is already gone. This is why the idea of waiting for confirmation sounds reasonable, but usually destroys long-term outcomes. By the time confirmation arrives, supply has already shifted into stronger hands. Liquidity has already thinned. Risk has already increased. The price is already reflecting the new structure. What feels safe emotionally is often the most dangerous point financially. And this is the line you have to draw for yourself right now. Either you treat XRP as a long-term strategic position that you manage with discipline, risk control, and a realistic timeline, or you treat it as a source of constant emotional stress that you'll eventually abandon at the worst possible moment. There is no neutral middle ground once markets enter this phase of transition. None of what's happening guarantees success. Nothing in this market does. XRP can still underperform. Macro conditions can still turn against risk. Regulation can still slow adoption. Expectations can still outrun reality. All of those risks exist, and pretending they don't is how people end up overexposed and blindsided. The goal isn't blind optimism. The goal is informed positioning. So the real takeaway from all of this is simple. Understand what you hold. Understand why you hold it. And understand the timeline you're committing to. If your plan can't survive boredom, it won't survive volatility either. If your conviction only exists when price is moving up, it's not conviction. It's momentum chasing. And as always, this is not financial advice. Everything discussed here is for educational and formational purposes only. I am not a licensed financial advisor. You should always do your own research, verify everything independently, and make decisions based on your own financial situation and risk tolerance. Never invest money you cannot afford to lose, and never rely solely on any single source, including this one, when making financial decisions.